In the second part of our discussion of the financial environment of the United States, I'll discuss both how stocks are issued to the public and how they're traded by investors. We'll examine both the primary and the secondary market for securities, discuss initial public offerings and the role of investment banks in those offerings, and discuss the mechanics of the stock exchanges. We typically break the stock market up into two categories, the primary market and the secondary market. The primary market is the market for newly issued shares of stock by firms to investors. The stock is issued to investors to raise new cash for firm operations. Firms can use a variety of techniques to raise this cash. Sometimes, rather than issuing new shares of stock, they'll issue bonds or get a loan instead. Regardless of how they raise the cash, they will generally work with an investment bank. Investment banks help sell new shares of stock and new bonds to the clients of the bank. They receive a commission called flotation costs in exchange for helping issue these securities. The secondary market consists of the market where investors trade shares with other investors. The stock of private companies like Cargill or Koch Industries trades amongst a smaller number of shareholders and is often not publicly disclosed. The secondary market for the stock of public companies is usually the exchanges like the New York Stock Exchange or the Nasdaq. If you're interested in investing in stocks, you will usually need to open a brokerage account to buy and sell shares of publicly traded firms. Now, I think it's a good idea, before I go any further, for me to define all of the different ways that a firm can issue new shares to the public. The first is through a private placement, which is just a case where a firm sells a specific number of shares directly to one investor. Both public and private firms can make private placements to raise new capital. Next, we have an IPO, or initial public offering. This is the first sale of equity a private firm makes to the public. Before a firm can be listed on an exchange, it usually sells new shares via an IPO. At that point, any client of the firm's investment banking syndicate can buy shares of the stock that's undertaking the IPO. After the IPO, the firm's shares are said to be traded in the secondary market. A secondary equity offering is an additional stock issuance made by a firm that's already undertaken an IPO. SEOs, as they're sometimes called, allow a firm to raise additional capital by issuing new shares of stock very quickly. Finally, we have a rights offering. And a rights offering is a case where a firm sells shares to current shareholders on a pro rata basis, meaning that the percent of new shares you get to buy is dependent upon the percentage of outstanding shares you already own. So if you own 50% of the shares outstanding before the rights offering, you get to buy up to 50% of the new shares being offered. Now let's focus on the steps of an IPO, which is the most recognizable of the ways that firms issue new shares. Before an IPO takes place, the firm's board and management will typically determine that the best way to raise new funds for capital budgeting projects is by issuing new shares of equity to the public. Chances are this is because the firm has exhausted its ability to borrow from financial institutions or issue new shares to their current investors. Once a firm decides to undertake an IPO, it will hire an investment bank. The investment bank will meet with the firm, help the firm identify how many shares to issue, and help the firm's management draft the registration statement and prospectus, which are provided to the SEC, otherwise referred to as the Securities and Exchange Commission. The SEC reviews these documents and checks their accuracy. The investment bank might also ask additional investment bankers to help sell the shares to their clients. When this happens, the investment bank is said to have formed a syndicate, or an underwriting syndicate. The next step is to literally take the show on the road. The firm and its underwriters, as investment bankers are sometimes known, will travel to meet various clients of the investment bank, or the syndicate, and attempt to convince those individuals or financial institutions to state how many of the new shares they'd be willing to buy and at what price. Once the roadshow is completed, the firm and its underwriter syndicate will determine the ideal price per share for the new shares and the number of new shares the firm will actually issue. And then finally, they'll complete the final registration statement with the SEC. The syndicate will distribute the shares to their clients, and the shares will begin to trade on a specific exchange the next trading day. Usually, earlier investors are prevented from selling their shares for the first 6 months after shares begin trading on an exchange. This period is known as the lockup period. One final point I should note is that sometimes an IPO will involve shelf registration, which means that a firm states that it may be willing to issue new shares to the public as part of the IPO at some point in the next 2 years. Now let's talk about investment bankers in a bit more detail. Investment bankers are referred to as underwriters when they sell securities for their clients. They act as the client's agent and can sell any type of security, not just stocks or bonds. A collection of investment bankers that helps issue an IPO is an underwriter syndicate. Most large issuances of stock require a syndicate to sell simply because the volume of most large IPOs is too much for one investment bank to handle. Investment banks are compensated through the use of flotation costs. Nowadays, flotation costs of investment banks, which are a percentage of the cash raised by an issuance, typically are right around 7%. There are two ways that investment banks issue shares to their clients: best efforts and the firm commitment method. Best efforts means that the investment bank promises to do its best to issue the shares. If it can't sell all the shares, those shares won't be issued. With the firm commitment method, the investment bank buys the outstanding shares and retains any shares it doesn't sell to its clients. Because it's going to be stuck with those shares if it doesn't sell them, the firm commitment method is a much stronger signal to investors that the underwriter believes the shares are valuable. When a firm's management wants to list the firm's shares on an exchange, the firm needs to pay the exchange annually for the right to be listed. The exchanges provide a couple of benefits. First, they typically provide media exposure for the firm. Investors hear about a security more often, which makes them more likely to buy the shares or at least research the stock. Being listed also provides additional liquidity for the stock, meaning that the investors can sell the stock's shares quickly at the price it should be worth. Finally, because listed stocks have been scrutinized by the SEC and other investors, new investors can feel reasonably confident about the value of the securities. Physical stock exchange historically were not-for-profit organizations owned by their members, who held seats that gave them the right to sell on the exchange. This type of ownership is called the mutual ownership structure. Most exchanges became demutualized when the organizations became private companies. Historically, brokers paid for the license to buy or sell shares on the trading floors of these exchanges. The exchanges, like the New York Stock Exchange, also have designated market makers for each security who ensure the shares are traded. In the last 30 years, this model has changed dramatically. Let's take a look. With the rise of the internet and high-powered computing, it's become less important to have a trading floor. This is the trading floor of the New York Stock Exchange today. Historically, this is where some of the biggest trades occurred. Today, most of the trading on the New York Stock Exchange occurs online. If you want to buy shares of Ford Motor Company or General Motors, you'd be far more likely to buy those shares through an online broker than on the floor of the New York Stock Exchange. Large orders still take place here, but the pits are far less busy now than they were even 20 years ago. Most stocks nowadays trade OTC, or over-the-counter, through electronic communications networks, which link brokers and dealers with each other. The best example of this is the Nasdaq. Brokers can connect with the Nasdaq servers to trade with other brokers online for themselves as dealers or for their clients as brokers. Trades happen automatically as computers match up orders based upon the prices investors are willing to buy or sell at. The Nasdaq is one of the 3 largest exchanges in the US. The other 2 are the NYSE and the NYSE MKT. The Nasdaq currently lists about 3,300 different stocks and stands for the National Association of Securities Dealers Automated Quotations. In terms of total market cap being traded, it's the second largest stock exchange in the world behind the New York Stock Exchange. This system allows investors to trade online with ease. The Nasdaq, like the NYSE, holds normal trading hours from 9:30 a.m. to 4 o'clock p.m. and has both pre-market trading and after-market hours. Firms will face the question of where they should list when their shares go public. The New York Stock Exchange, or NYSE, is the largest exchange in the world by total market cap and has historically listed the stocks of the most valuable companies in the United States. The Nasdaq has historically listed smaller companies and firms in the tech sector. Apple and Google are both listed on the Nasdaq. A firm can choose to list on multiple exchanges. When it does, this is called dual listing. Usually, the firm being dual listed is a foreign firm that lists on the exchange in their home country and one of the U.S. exchanges to attract U.S. investment. An example of this is Royal Dutch Shell, which lists on both the London Stock Exchange and the New York Stock Exchange. Recently, due to the rise of technology and the ease of trading online, the exchanges have undergone a period of consolidation. Smaller exchanges have been acquired, while several larger exchanges have been merged. For example, in 2007, the New York Stock Exchange was merged with Euronext, a European stock exchange. So let's sum up what we just covered. Stocks can be sold to investors in a variety of ways, both on the primary and secondary markets. The most prominent sale on the primary market is an IPO, which is the first time shares are sold to the public. Once a firm undertakes an IPO, the shares are listed on an electronic exchange like the NYSE or the Nasdaq. Finally, we know that some stocks, particularly foreign stocks, can be dual listed or listed on multiple exchanges. So that's it for this part. In the next part, we'll discuss the financial environment in a little more detail, and I'll focus on the financial intermediaries and the important legislation then. Thank you.